Hello class, we're going to review some of the important points of Chapter 1. I'm going to use these PowerPoint slides that you have access to do some review. This is also the material that you find in your textbook, but hopefully we'll hit some highlights of things that may not be as clear just if you were to look at these on your own. So here we go. Taxpayers, we're going to start here with we're talking about individuals for almost the first 3/4 of the class. We'll get a little bit into corporations and partnerships much later in our textbook. But this is the taxpayer we're talking about, and we'll focus most of the time on. Here's your formula for calculating your taxable income. This applies to both individuals that we'll be focused on as well as C corporations. We're looking at all income. We take out the exempt, we get our gross income. So as we focus on individual pieces of it, calculating gross income is simply taking basically everything that your list is pretty long here. The idea is everything you receive as income is included in this measure. So some things you might not even think of we'll talk about in Chapter 3. This is not the whole list. The idea is it is to be comprehensive, even if you don't receive it in cash. So gross income includes even things that you might think of as given to you as a benefit that your employer provides for you. If they give you a trip somewhere as a reward, that's gross income. So unless it is specifically excluded, it is included. That's the general rule. Some are excluded. That we'll talk about in Chapter 4. So after you get your gross income, you subtract deductions. Those deductions are either for AGI, adjusted gross income, or from AGI. And for AGI are the most valuable because AGI is used for other calculations in the tax law. So a reduction in your AGI may increase your deductions elsewhere, and we'll see how that works later when we get to some other things. Some of your deductions for AGI are listed here. Some of these, second slide with more of them. Some of these are listed at the bottom of page 1 of your 1040. So you may, if you look at a 1040, you would see some of these listed. The others are calculated on other schedules. So once you have your AGI, you deduct the from AGI deductions, and individuals either deduct will deduct itemized deductions or the standard deduction, and at least for 2017, personal and dependency exemption deductions. So then we need to talk about what those mean. So notice the thing about the greater of the taxpayer's total itemized or total standard deduction. So you got to figure out both and then compare, and you take the highest, not both of them, but whichever is the highest. So you get the best deal, but only one of those. So here are some itemized deductions. We'll talk a lot more detail about those. For now, we're going to focus on the standard deduction. But here's some things that show up as itemized deductions. What we want to spend a little more time on is the standard deduction, which is the basic standard deduction plus an additional standard deduction. This is the part that tends to be forgotten, is that you get an additional standard deduction for being over 65 because of age, or by being blind, which is defined as eyesight worse than 2200. But those are the two things that get you an extra or additional standard deduction. So you have to pay attention to that. Okay, and it depends on their filing status. So there are 5 filing statuses, and we'll come back to these to define them more. But basically, if you're married, you can choose one or two, either married filing jointly or married filing separately, and that is based on December 31st, what your status is. If your spouse passed away, you are could be a qualified widower. Okay, in the year that they die, you are still married, filing jointly, but only if you have a dependent child could you be continue to be a qualified widower, which is basically the same as the married filing jointly for 2 years after the year that your spouse dies. Head of household and single are your two choices if you are single, meaning if you're divorced or legally separated as of December 31st. Head of household is for those who have the dependents living with them or that they're supporting. We'll talk more specifically about what that means, then of course the single. So these are the standard deductions in the law. So you take this, and then if you are blind or older, then you get the additional standard deduction on top of them. So before you compare to see whether your standard deduction or itemized deductions are higher, you have to consider this additional as well. Notice that I've highlighted these because they're different for people that are singles. These two statuses get $1,550 for being blind or old, and the married people only get $1,250. So it's important to remember. So some examples. Okay, you see how they took this basic for being jointly and $1,250 for additional. Divorce, so they have to be single. So they have a head of household, they must have a child or some other dependent. Okay, they're not old and they have good eyesight, so standard deduction is head of household amount. Single and blind and over 65, so they start with a $6,350 for being single, and then 2, that's the maximum they can have. So here's the other tricky part about standard deduction. If you are a dependent of another taxpayer, and we haven't even defined dependent for you yet, but that will be later. But if you are a dependent of another taxpayer, then your standard deduction starts not at the ones we saw earlier, but at $1,050, or how much you earned in a job, earned income. That's jobs or working as in a business of some sort, plus $350. So those are your two. It's one of those two. It's the greater of those two. It can never be more than $6,350, which is the regular standard deduction. Now, if you are 65 or blind, then this would be increased by those extra amounts, as we saw earlier. So example, 18, he earned $2,200. He's going to take the amount earned plus the $350, because that's going to be obviously more than the $1,050. Okay. Lauren gets $6,400. Her standard deduction is a $6,350 because it's just more because her earned income is more than the normal $6,350. 72. Stan is a dependent on his son's return, $550. Okay, he has no earned income, so obviously the earned income amount is 0, and the $1,050 is the highest, so that would be his standard deduction. But he's also over 65, so you add that $1,550 for being older, and you get $2,600. Exemptions. If you are claimed as a dependent, exemptions are one place. They can be only claimed by one individual. So if the parents claim someone as an exemption, that child cannot do so, or vice versa. So if you're claimed on somebody else's return, you cannot be claiming on your own return. For 2017, that's $4,050 for each exemption and is phased out over these thresholds. Okay, so the calculation is if AGI, remember how I told you AGI is important because it affects other deductions. Here's an example. AGI gets over these thresholds and you start to lose your exemptions. So example, AGI 356, you got 5 personal dependency exemptions on the return. So typically with 5, you would take 5 times 4,050 and subtract that. Okay, that's 42,550. How 5 times, that would be 2,200. Echo. They're over the threshold by 42,550. Divide that by 2,500, you get 17.02. Normally you think, oh, I will round that to 17. Not in the tax law in this scenario. It says for every 2,500 or portion thereof. That means you have to round up no matter what. 18 times 2, 36% reduction. So instead of getting the full amount, you only get the remaining 64% of the exemption deduction. So here's your total, here's your 36% reduction, here's your 64 you get to keep. So on your calculation of taxable income, this is the number you would use. Okay, so the phase out works between those two. If your AGI is over this, you get no exemptions. If it's below this, you don't have to make any calculation because you get all your exemptions. So this only applies in between these numbers. So what do you get exemption for? For your taxpayer and taxpayer spouse, qualifying child, qualifying relatives, and qualifying non-relatives. So criteria for qualifying child. I'll let you can read these, okay, but notice that they have to fit all 6 of them. The biggest one is that the relationship test is pretty narrow. Descendant, child, grandchild, sibling, or siblings descendant. That's nieces and nephews. Under 19 or under 24 if you're a full-time student, and you must live with the taxpayer's home for over half of the year. It does not have to be all year, just over half. Okay, the person cannot provide over half his own support. The person that we're considering, so your child cannot provide their own support. And then generally they can't file a joint return unless their income is so low that they don't need to file. And then there's a citizenship test, which is usually not an issue. So what about when parents are divorced or separated? Custodial parent, non-custodial parent can only claim it if this is filed, the form that you see in front of you, Form 8332, releases the exemption to the non-custodial parent, usually in return for paying child support. Qualifying relatives, you'll notice, has a fewer tests. So if somebody isn't a qualifying child, then they might be a qualifying relative. The first, you always start with qualifying child, and then you broaden, okay? So it'd be relative, and the relative list is much longer here than it was for the child. And now the taxpayer has to provide 50%. It's not an issue about the dependent providing, it's whether the taxpayer provides. And the one that usually trips us up, they have to have gross income less than the 4,050. Okay, then these other two are exactly the same as for a qualifying child. Relatives here, under qualifying relatives, look how long this list is, much longer than for a qualifying child. Finally, qualifying non-relatives, even someone who's not related to you can be a dependent if they live with you the entire year. So they cannot be living somewhere else any part of the year. They still have to pass citizenship, support tests, gross income test, and the joint return test we talked about earlier. Tie-break rules, one parent always wins. If both parents qualify, the custodial parent wins. If there's no custodial parent, the exemption goes to the parent with the highest AGI. What about multiple support agreements? This is the idea where there's a group of people. Say mom is in a nursing home and the 4 kids all chip in to pay for her care there. So if together the 4 of them pay over 50% of her support, then one of them can claim her as an exemption, but only one. So they have to agree who's going to do that. And that's what a multiple support agreement is designed to do. The only thing, the person who gets that exemption must have paid at least 10%. So if they all did 25%, then any one of the 4 could do so. But if, let's say there were three of them that put in 33% each, and then the 4th one didn't put anything in, they could, but went to visit her more often or something like that, they would not be able to claim her as an exemption. It would have to be one of the other 3. Okay, and the form is 2120, and you'll see an example here. That's how it's to be filled out. Looking at the various statuses, filing jointly or separately if you're married. There are penalties for filing separately. It's generally not a good idea, but once in a while you want to check that, see if that's a better deal. You can go back and forth, 1 year jointly, 1 year separately, it doesn't matter. Qualifying widows, remember we talked about this. This is only for those that have a child that they pay 50% of the household costs. So you got to be supporting. This is for that the young, somebody that dies relatively young, kids are still at home. The surviving spouse doesn't remarry, they can continue to file jointly with their deceased spouse or for 2 more years after their death, assuming that they have a child at home that they're supporting. Head of household is just what it says. You're supporting someone. The abandoned spouse rules are just about helping that spouse where somebody abandons them, the husband takes off, won't do anything to help, but you can't find them to divorce them. So they're still technically married. This allows the person that is still being responsible, then supporting the children, to be able to claim head of household rather than married filing separately, which head of household is better for them tax-wise. Notice you can be head of household even if you have a dependent parent living in a say assisted living facility or something where you pay over 50%. So they really loosen that up in order to help for those that are supporting elderly parents. So who has to file? You have to file a return if you fit these criteria. So if your income is low enough, you don't have to actually file a return. But if your income is over usually the standard deduction and the personal exemptions, then you have to file. So there's some examples here that we're not going to spend a lot of time on. As long as you understand, it's the same kind of calculations as figuring out the standard deductions.